Hi folks. So here we are with the third video of the three that we are doing on depreciation. In this one we're going to do two things. We're going to talk about how to calculate depreciation for part years. So if we buy an asset in the middle of a year or partway through a year, how do we figure out the depreciation for that? And then we're going to look at how to actually do the journal entries for it. So I've got a little bit of a timeline going here. So we've got our fiscal year, which is the same as the calendar year in this case, from January 1st, 2014, and then our second one in 2015. So we've got 2 years worth here. We're going to use our same example as we have been so far. We're using the car that's $32,000. In this case, we're going to use the annual depreciation from the straight line method of $3,000. Which is fine. It'll work. This process works the same no matter which method you use. It doesn't really matter. So the thing about this $3,000 in depreciation is that it assumes that we are, if we use the whole thing, it kind of assumes or implies that we bought the car on January 31st. So in that case, we would have kind of a depreciation calendar, if you will, that would look kind of the same. And so for this year, it would be $3,000 the full amount, the second year, $3,000 the full amount, and so on. The problem is often as in life is that life is not that neat and tidy. We often buy assets in the middle of the year when we need them, and we have to treat them differently. So in this case, let's imagine that we are buying our vehicle on April 1st instead. So I'm just going to kind of adjust this down here. April 1st. So now what we have to do is calculate the depreciation for just those months. And so if you've done, if you know, since we've done the depreciation, or not the depreciation, calculated the, partial use of prepaid insurance, this process is going to look a lot the same. So what we have to do then is figure out, and this is what we're looking at here, the time period is 9 months from April to December, 1, 2, 3, 4, 5, 6, 7, 8, 9. So we have to figure out 9 months worth of depreciation that we can use or put towards or against our revenue. And so the process is quite simple, again, very much like the prepaid insurance process. So we're going to take our $3,000 and we're going to divide that by the total number of months in a year, which is 12, and that will give us $250 per month. Since we have had this now for 9 months, not 12, we're going to take that $250 and we are going to multiply that by the number of months that we actually did, and that will give us a total of $2,250 in depreciation. So what that means then is that in this first year, rather than taking all $3,000 worth of the depreciation, all we can actually take is $2,250. And so if we're going to calculate our book value, and this is really important for the declining balance method, you wouldn't use the full amount for that year to go towards your accumulated depreciation. We would have our purchase value, and then the next year when we go to calculate our book value, we would use that $2,250 as the accumulated depreciation to get our new book value, which would be $29,750, which is, you'll notice, is not as high as or higher than, because we've taken less off than the book value that we got in that example. So then what would happen is for the subsequent years where we own the vehicle, and I think we talked about the number of years that we would have the car would be 10 years. So this is the first year. There would be 9 years where we would have a full $3,000 in depreciation. What would happen then at the end is that in the 11th year is that we would have the car for 3 months of that year before we had planned to get rid of it. And so we're going to have to make sure when we get to that point that we don't calculate or use that $3,000 for that full year, because if we're disposing of it on March 31st, we'll have only had it for 3 years. So we're going to go through the same process again, although we have kind of the information here in front of us. We would take that 250 and we would multiply it by 3 months at the end, and so then that would give us the final depreciation of 750 for that last year. And you may notice if you add 2250 and 750, you get $3,000, which is our full year. All right, so that ends that part of the process.